And like yesterday, you're fighting the machines, you're fighting AI. Yesterday, Slack just uninstalled itself. Poof. And you guys know I run two computers, so I just rolled my mouse over to the other computer and turned Slack on the other one. 30 seconds later, poof, it just uninstalled. I've never seen that happen before. And it didn't go through some uninstall dialogue like, hey, do you want to get rid of this? It was just gone. How's that for some crazy stuff? That's going to be uh, interesting going, finally moving that PDT from 25K to 2K. You know, everybody keeps asking, like, who's buying at the highs and how did we get to such elevations? And it's fresh money. You got to have fresh money in the market so that they have some victim to take the money from. I hate using that word, but I don't have a better one. Sucker, victim, you know, put whatever fits there for you. So dropping the PDT from 25K to 2K just offers them a fresh pool of targets. That's a good word, right? Targets word. We're almost there, guys. Just figuring out the rest of this bot, and then we're almost there. I heard this morning that by the end of the week, 14 out of 19 Fed speakers will have given a public appearance, and that's from now until Friday. 14 out of 19 Fed speakers will have a public event. I mean, it's not like we're expecting them to say anything new. Okay, we're good to go. Good morning, everybody. We are looking at some market on close sell side imbalances to start popping up into the month end. They are estimating the U.S. pensions are modeled to sell $21 billion of U.S. equities for month end. Just to put that into perspective, 21 billion to sell ranks in the 89th percentile amongst all buy and sell estimates over the past 3 years, but it's in the 92nd percentile going all the way back to the .com January 2000. Now think about that for a moment. And if you're not into math, I get it. You know, I really do. You should work on that because if you're going to be a trader, you really need math. But that's big, right? If you don't understand the comment, give it to your favorite AI and ask it to slim it down for you and feed it to you with a spoon. It's really important. Now, this goes to the comment that we saw earlier this month that said that we're going to be in a blackout mode with over 75% of the marketplace by October 9. The stock buybacks will be in blackout mode, is what I meant to say, right? Just for some context. So if we have sell side activity and a lack of buy side activity going into October, then should get to be pretty fun, huh? We don't see this yet. And the word estimate has to be taken into consideration. They estimate that it's going to be this. They can be wrong, right? Numbers lie, and that's a fact. And anybody who knows how to play with the numbers can make them say all kinds of stuff just to dance around people who don't understand the numbers all the time, right? I do it with the kids. It's really easy to do. You just play the numbers game, right? So maybe one thing of note, and I have a client who had brought up to me that there was a trucking company that was running from Texas to Oklahoma, self-driving. Well, autonomous truck startup Kodiak is going public tomorrow. Its trading symbol is going to be KDK, KDKRW. What do you think of that, bro? I thought of you when I saw that and said, you know, it's there you go. It's on now. There are some problems, right? They can't go everywhere. They can't deliver anything, but it's going to save companies so much money. On the other hand, my son, who's an over-the-road truck driver, he just drops trailers and picks trailers up and, you know, goes from city to city. He's not going to like this because it's going to threaten his job someday. But he's a smart kid. He can get a job doing something else. DTAs have still not turned around, still pointed to the downside. This is for the S&P. This is for the NASDAQ. They look almost identical. At one point, I was even considering the fact that they weren't even two different charts, that they were just changing the name at the top. That's how close to being the same they are, but they are two different charts. Crude finally getting that breakout. This is CTA breakout that we're talking about, right? But put it into context. I don't know if I turned my pin on this morning. I guess we'll see. Hey, there it is. This is the lower one. I do better than that. This line right here, we broke out of. And it's just a smidgen lower than this line. But there's still these three combined. We still have that to get into, right? Which we're basically there. That's just being picky though, right? Because we would put this whole thing in a box and they're breaking out of it. The next range is all the way up here. So we're talking about getting higher than this zero. Clean all this up. Here's the percentage values, right? And here's the zero line. This is the crude's price over here, in case you didn't know how to read this chart. So we got the white line, that's crude. It's just under $65 a barrel. But the CTA's position is no longer negative, it's positive. Every time they were coming back through into positive territory, they were dropping it back off. And they have not been above this 0.01% for quite a while. It goes back to April 7 low, the April 7 capitulation when the bond vigilantes forced the president to bend over or restate his position. That sounds better. Yeah, that's what I meant to say. So now we're getting a shot at getting back up above it. But once we do, we still have that next cap, 0.02. Because even back before April, we were still holding underneath that. If we can get above that, then it goes into like 0.35, maybe even 0.04. Keep your eye on crude. We don't know if this is going to turn around yet. CTA's breakout in silver into a position that they haven't been in for a while. We don't have depth here, you know, like years back, but we can see 2023, 2024, and now into 2025. This is their highest position that they were in silver before they began to unwind. And I'm sure they were salty about it too, because they unwound, but silver really didn't fall out. And if we snapped a Linreg line on this, it has just continued to go higher. So they're piling back in it. Still, we are back at that previous level. So, be mindful. And talk about being underweight. This is gold. CTA positioning is still down here. If we were to treat this like IV rank, and try putting it into percentile, then over the last year, we're sitting at like a 25 IV rank. They've got plenty of room to expand in this thing to get back up into their previous position size. They could almost double their position size from where they're at and still not be a blowout. Yeah, I've seen that posted before. Switch to the advanced mode and ask how stare. Getting pretty bad out there, isn't it? We are going to get job numbers today. Now, these aren't the numbers. There is a particular set of job numbers that are really important to the market. These aren't those. But any job numbers are something to pay particular attention to, because Powell pivoted after coming out of Jackson Hole. And now it's, well, inflation's okay. It's still a problem, but we've really got an issue with the labor market, and we're going to have to choose which side we focus on, because it's a dual mandate that they have. And if they mess with one, it hurts the other. And if they mess with the other, then it hurts the first one. So no matter what they do, one side isn't going to work out too well. And they always have to make that decision. Well, he pivoted away from uh, inflation, saying that now employment is the number one issue again. For a while, it was nothing else matters but inflation. We're going to focus on inflation, and jobs are fine. Well, now inflation's fine. Jobs are really important. So anything to do with jobs, you want to pay particular attention to. The market will. We're not expecting all of these Fed members to actually provide new information. Most of them are just going to sing from the hymn book, and it's very likely that they're going to make comments about the government shutdown that are coming, or at least that they're going to be asked about it, maybe some gotcha questions. And that is the only reason that I think it's worth paying attention to when they're going to be talking. It's that gotcha moment that can really squeeze things. So Powell's typical approach to media presence is, I'm going to talk without really saying anything, and I call it Operation Don't Rock the Boat. Run his mouth, chip teeth, and never really actually say anything of note or of import. The rest of these guys, they don't do it as good, but that's kind of the goal, just to collaborate, agree with everything that's going on, don't rock the boat, and get through the interview. But because of this government shutdown and just the multitude of all of them, if they start trying to vive for the spotlight, then they may start to, say more and more hyperbolic things just to get a little louder, just to get a little more attention, to stand out above the person that was in front of them. And if they get asked about this government shutdown question, things can just really get out of control. So keep your eye on the various multitude of Fed speakers over the next 2 days, who's speaking, when they're speaking, just so that you don't get ran over by some gotcha question that spikes the market and smashes your stop. We got auctions in the front end. We got the 4-week. I mean, it doesn't get much closer than that. And then the 7-year, a little farther out. You could just probably use the IRX on those. The numbers aren't even out of line. The PCE numbers, they're just right there. Now the durable goods, I don't know that I kept circling back to this last night. I don't know. That's off. That's way off. But is the market even going to care? That's the rub. So at 8:30, watch out because this could be the one thing that gets everybody going. So this Fed member says he wants to get a lot closer to neutral in the coming 6 months, which is funny because neutral's like a unicorn. It's some mythical beast. You can't find it, and you can't even prove that it's real. He's looking for the neutral rate, while some other guy has argued that the neutral rate is actually lower than where we thought it was before, that it's not around 2.25 to 2.5. It's actually like around 175 to 2. They can't even agree on where neutral is, but he wants to get closer to it. They're just talking out the side of their neck. The call and put wall did not move. We are under the volatility trigger. We are below the 0 gamma line, the 10 and the 20, the 10 and the 3, and we have the 20 coming up. 66.37 is the 20 period daily moving average. Now, just because we are poking down below the 0 gamma does not mean that we're, quote, in a negative gamma environment yet. This is just a one-day thing at the moment. We want to get firmly below it, close below it, sustain that spot below it, and then we'll begin to consider what the dealers are going to do and how they'll react. If you're unfamiliar with the concept, the way that dealers manage the things when we are above the 0 gamma line is that on breakout days, they will sell into that strength. And on breakdown days, they will buy into that weakness. That's the behavior of them because they're trying to remain delta neutral in their books. But that changes when we're in a different environment, right? So once we go below the 0 gamma and we are firmly below it in a, quote, negative gamma environment, they will sell into selling and they will buy into buying. It's because of that behavior that bear markets have seen some of the biggest bullish moves in history, right? Those situations where we've made some of the biggest moves that we've ever seen to the upside was in a bear market. In the Spot Gamma's founders note from last night, they have the Spot Gamma, quote, gamma index. Like, can you say gamma one more time? And that thing goes from a -4 to a +4, right? That's the range that it uses. When we are really close to the +4, that's when they are strongly selling into rallies and buying into weakness when we start to fall. When we are the other side, when we're a lot closer to this side, then they sell into selling and they buy into buying. Right now, looking at last night's Spot Gamma's gamma index, it was at a 0.8. So we're really close to 0. that's not helpful, right? That doesn't give us insight on them buying or selling into breakouts or breakdowns. So the fact that we're below the zero gamma this morning, don't let that make you believe that we're going to see them sell into selling. I wouldn't anticipate that behavior at this point, right? We have to be, we got to get the entire structure below zero first. It is worth noting that the 3-day is still above the 10-day, so we haven't had a surge signal yet. If you want that in context of a daily chart, we're looking for this 310 cross. We don't have it. We do have these lows started, but this is the pivotal low of importance, 6611 cog line, and we're not there yet. We got a good 50 something, maybe 60 points to go before we get to that point. So if we don't put in a lower low, then all of this is just a pullback. It's not even a topping pattern. So, again, don't get all bared up out there thinking the market's done and we're headed to the downside and blah, blah, blah. Sure, we're going to have a lack of CTAs. We're going to have a lack of big funds that are buying. There's a lot of sell side on the MOC anticipated. There's the stock buyback blackout in October. All of those things are projected. We don't have them yet. We're not even seeing signals of them yet. We are anticipating them, we are projecting them, but we don't have them. And you can front run it and try to get ahead of it and think that it's going to actually happen, but the markets have been known to pivot. So, you know, uh, plan accordingly. We had some decent volume in the overnight, 75.8, pretty close to like 76,000 in the overnight. We've been running in the 50s, one day in the mid 60s, but 50s are what we've been doing pretty well. 75, it stands out. It's not too much. It is an elevation from what we have been seeing. The Open of Europe gave us this reversal. Of course, it didn't stick and we wiped it back out again. That was like a move into the kill zone. Actually, the kill zone started here at 2 a.m., dropped down. We ran back up to try to close the gap. That failed. We didn't get the gap closed. Almost. Just didn't quite make it. And then down we went to kind of unwind that move. So after Europe closes today, keep your eye on the market and see how much things change. If they are a part of the cause of us getting this week, then once they close, the lack of their negative pressure could be all we need to buoy back up again. Think about throwing a ball into the pool. As long as you hold the ball underwater, it'll stay underwater. You let up on the ball and it's coming to the surface. If this negativity that we're seeing today is attributed to Europe and its open and its markets, then once they close, that could be the lack of negative pressure we need to buoy back up again. We don't know that yet, but worth considering. We are at the ADR half. It's funny that this is coming up because we were just talking about this yesterday. So typically, if you get to one ADR early enough, you can get to the other one by the end of the day. That does not mean we're going to go up here. I'm just pointing out the fact that if you get to one side early enough, you can get to the other one by the end of the day. The thing is, how early is early enough? Well, I like it to happen, around the kill zone. Somewhere around midnight to 2 a.m. is good. 6 or so is okay, but you're kind of getting into it because half the day is already done at this point. And looking at the continuation that we're seeing here, it's more likely we're going to go to the full ADR, right? So what happens at the full ADR? Well, technically that's where we should stop, right? Because that's what we have done consistently over the last month is move about that much, and then that's what we get. If we keep going, there's nothing down here. So how do we define where's that stopping point if we get through the yellow line and we keep going? Well, interesting enough, the SPX does not get its ADR lines until 9:30. The ES got its ADR lines last night when it opened. So at 9:30, the SPX will get brand new ADR lines separated by what 0.83%. So once the SPX moves to its ADR lines, that's when we'll stop. At least that's what we've done before. So if we get through the yellow line and we are continuing to head to the downside, make sure you keep your eye on the SPX, put the ADR lines on that and monitor it, because when it hits the ADRs, it's likely the ES is done. If you don't want to use the SPX and the ES, then you could swap out with the NASDAQ and the QQQ. Yeah, taking a lead ball in the pool is a really good idea. I like it. You remember that diving movie, Men of Honor? Cuba Gooding Jr. and Robert De Niro? Those 100-pound diving suits or 200-pound diving suits? Come on, that was a really good movie. It wasn't that far. Come on, it's not that old. That's a really good movie. All right, so we cut through the weekly floor pivot. We are now below it, but we're not extended beyond it. Today's daily floor pivot is lower than yesterday's. Price opened underneath it. Both of those concepts are bearish, and we cut the weekly, and that's also bearish. Any move to the upside today, the focus is first, get back inside of Wednesday's price. Second, get back above the weekly floor pivot. 3, get back to our daily floor pivot. Those are some big, tall orders right there. Any one of those 3 would be a challenge. We are already through S1, and we are held underneath it, which puts S2 on the table. That's 66.50. We talked about those halves before. We're running halves, not wholes. So that is the next target and the next stopping point. We expect to digest that level. I'm not saying that we're going to turn around and go back up from there, just that we should pause there at the bare minimum, hang out. And I'm not talking to the tick. So we could overshoot it. We could come up short a little bit because they could front run it with a 54. But that's the next stopping point and digestion. If we lose that, then it puts 55.50 on the table. That's just the way it works, right? 65.50, not 55.50. What's the matter with you? Yeah, bro, I started trading when the ES was at the 28s. So the old days, it wasn't that far ago. The ES was at 28.33. I swear it feels just like last year. All right, this has been really nice. Clean, organized, efficient, no fear, no chaos. Look at that stair step very clearly, very cleanly. We had that unusual market behavior up here. You couldn't ask for it any better than that. Yeah. Yeah, I do have videos from back then, don't I? So now the question is, what next? Well, the good thing about having such a clean, organized price is that we can attempt to do what the textbooks suggest we do. And what they suggest is you measure the legs and then you measure the pullbacks. So we would take that leg and set it on the next spot and ask the question, is it speeding up or slowing down? If it had extended further than the line that we drew, it was speeding up, it was accelerating, the rate of change was increasing. If it didn't match or extend beyond, then it's slowing down just a little bit, is what we can see here. This leg down was less than this leg down, but only barely. And now we're in our current drive, and that measured move tells us where the next stopping point is. Hey, look at that, 66.50. Who'd have known? Never saw that coming at all. The next thing you can do, though, is you can focus on these pullbacks. And you can do the same thing with those. Now, this is straight out of the textbook. This isn't something that I thought up, right? This pullback matched that height. The slope and the curve, don't get too picky on it. If I had used this wick instead of that wick, this line would have been a little closer this way, but it would have been the same spot, right? So the depth of this pullback was still the same. We can just take this and we can set it down here, and that'll give us the pullback height, which would line up with this pivot. And that makes sense because when we pulled back here, we hit that pivot. So now when we get to this point, we start to pull back, we're going to expect to hit that pivot. Ta-da! Kind of get the idea now, huh? That should get us pretty close to 66.11 cog line, which is that low from last week. Right now, I'm ballparking it here. Price can do whatever it wants, and the pullback could get shallow. The next leg down could be deeper. This is not, a forecast. We do have the point of control from last week right where we are right here, and that makes a nice zone. This whole area here. We're coming out of the other side of it, though, so if we do manage to get down below that, I don't think this value area low is going to help us out at all. 66.52, and I doubt it'll be useful, but 66.50 will. A little bit of an overshoot. It might be worth marking out that big bar, right? That's the FOMC bar. $66.48.5 is basically 66.50. So that doesn't help. Never mind. That 66.50's got a lot of structure, though. I like it. It's a magnet and gravity at this point. I don't see any other reason for us not to go there. Get to 66.50 and then we'll reevaluate things. 10-day, 30-minute volume profile and TPO. As we talked about yesterday, unless we came down into this zone and put more work in at the current point of control, this point of control was likely going to shift up here. Well, it still will eventually likely shift up here anyways, simply because we're going to wipe some of these candles off the board by next Tuesday or maybe Wednesday. But we are underneath the current point of control, and that's more relevant at the moment. Not where it could be later, but where it is right now. Now that we're here, we can hang out. It can become a gravity point all on its own. We don't have to expand lower than this and get into 66.50, but we already broke it, and I don't expect it to hold us up, right? It's not support, it's not resistance. And unless we're still here once we get into the RTH regular open, I don't think it's going to provide any sort of help to us. And I like 66.50 better. We do not have a new VPOC from yesterday, so nothing to carry forward. The point of control this morning on TPO and volume profile are lined up really nice. That's like a more classic P shape, except for these little micro distributions up here, kind of throw it off. And look at the way it's building out down here without the TPO. So we're getting the volume, but we're not getting a lot of trades. TPO, just think of it as how many trades did we get? Whereas the volume profile said, how much volume did we get? Now, that's not technically exactly right, but it's the easiest way to explain it to you, right? So if we didn't get a lot of trades, but we did get a lot of volume, that just tells you that the trades we did get had big size, right? Okay, I mean that's useful. But when we got down to this low, we did not reverse with big sell bars here. So, or with big buy bars here. So we didn't drop down into a bunch of buyers that bid it up and popped it to the upside. Sellers just got exhausted down here, quit selling, and we started to go back in the other direction. Big difference between those two. Like up here, we ran up into a lot of sellers. We can see there's a lot of selling activity up here. If we had run up and just ran out of buyers, it would have been thin like it is down here, and we'd have just faded off. So sellers piled into this, and they continued to pile into this. Down here, we did not get some buyers at the low to buoy it back up. We just ran out of sellers. Looks like we got some buyers here and some buyers here trying to slow it down, but maybe it worked, maybe not. We got a VPOC down here at 66.61. And of course, since I don't, zoom into the tick, maybe it's a couple of ticks higher or lower. It's 66.60 basically. If we cut through that, I don't think we have anything else. Yeah, no, that's it. If we begin working our way back up, we can go through shallow areas relatively easy. So back above 66.75, it gets shallow, and we could get back into 66.92 cog line, or at least back into the 66.80 area. But that would be all this trash up here. And at this point, I just continue to ask, what's going to give us that fuel? Because I don't see it. We are below the 10-day. We just eased our way back down there. No big drama drops like this, which is good. We don't want to freak anybody out. There's no flight to safety at this point. We're not seeing any, trampling people as they run for the exits. So that's a good thing. As long as we're within 0.5% on either side, we're good. And I'd argue even 1% on either side. -1 to +1 has been our zone. That's just a good, healthy spot to be in. There's nothing wrong with being under the 10-day for a little bit after pulling back to it, right? Because that's just a good part of the rotation, especially when you're still above the 10-week. As we can see here, we're clearly still above the 10-week, more than 2.5% above the 10-week. So we're still in a very healthy market backdrop from a price perspective. You got the 10-year and the dollar both making that little push to the upside. If I pulled the label off the top of these, right, remove the numbers off the side, if we just had the pattern, they don't look too dissimilar. The 10 years of more stretched, it's got a head start on the dollar. But other than that, like that, huh? Turn the ES upside down so that it matches the other two charts. Nah, it's just weird. So we are getting a breakout on the 10-year. The swag level is 4.2 and then 4.24 for today. We don't want to see that 10-year getting out of control, and that means moving too far too fast. For the dollar, I'd say 98 and a quarter. I have 32, 98, 32, but let's just keep it simple numbers like 98 and a quarter. Getting beyond that today would be too much. We start to freak people out. We don't want to do that. And in the VIX structure, we did come out of that 1.18 to the downside. We're still holding above the half, but this is implying that we're getting some the beginnings of some backwardation. We're not in backwardation yet. We're still in contango, but it's moving in that direction. So keep your eye on the VIX and the VIX curve. To put that into some context, right? If you're unfamiliar with the VIX curve, the VIX is dated just like anything else, especially in the options space. And the curve generally runs like that. Things that are close in time are cheaper because, well, we can see what's coming tomorrow a lot easier than we can see what's coming 3 months from now. In 3 months, we could have hurricanes, war, famine, all kinds of things. So the future is hard to know, and that makes the future more expensive. This is contango. It just means that volatility is normal. So you can look at a 1-day VIX, a 9-day VIX, a 30-day VIX, right? 6-month VIX, a 1-year VIX. Every one of those takes you further out on the curve. And each one of those, as you get farther out, should be more expensive. If that begins to flip, and the 1-day VIX suddenly gets to be more expensive than the 6-day VIX or the 9-day VIX or the 30-day VIX, then you're going to start to get a curve that's going in the other direction, that the front end is more expensive than the back end. That is backwardation. Now you can see that, right? You can see it very easy because there are things like a 1-day VIX. You don't need to use VIX futures, which is what I like to use. You can just use plain old VIX. So type in VIX and then put a number behind it like 1, and there's your 1-day VIX. Okay, so then you make a watch list that has the 1-day, the 9-day, the 30-day, the 1 month, 3 month, 6 month, 1 year. You can stack them all up in a watch list so that you can see them, and then you can tell, are we getting into backwardation? If you have Think or Swim, just look at the VIX futures. It'll make your life so much easier, right? So VIX futures, VIX or VX. Yeah, VX. And then now you can see the active contracts. So you can just scroll down, right? And in fact, put them in calendar so it's a little easier. There's the November, December, January, February. As we go farther out on the curve, you can see that it gets more expensive. 2190, 2165, 2150, 2110, 2020, right? It's getting cheaper as we come closer. If that flips, then we're no longer in contango and we're in backwardation. That's the easy way to do it. And you can actually visualize that, but we're not going to get into it. But Think or Swim will allow you to plot those on a chart and then actually see the curve, which is pretty cool. Think or Swim lets you do all kinds of neat stuff. You're supposed to be able to do it with interest rates too. I haven't had any luck getting it to work. Looking at what's down today, I mean, maybe it's just easier to look at what's up today. Nat gas, Mag 7 down volume is up. Gold miners and China, some of China. That's it. That's all we got. You don't want a rally day on nat gas, gold miners, in China. So we're going to need something else to bring this market back around, or we're not going to come back around. We could hold the lows. I'm not saying that we have to go lower, just that this won't get us to go higher. We need something else. Once we get into 8:30, we're going to get some data, and then all day today we're going to get data, and any of those data points could fire us to the upside. But what we have right now, this won't do it. Silver, gold miners, China, pot stocks, that ain't going to get it done, right? So keep your eye on the Mag 7 group. Look for some 0-day options flows once we get into the open, and see if we can get some market breadth that can actually turn this around and get us moving in the other direction. Otherwise, the best you could hope for today is that we stop falling where we're supposed to stop falling, and we start building out some structure at this level. So what I got for you guys, watch the clock, be careful, be safe. I'll see y'all tomorrow.